36 minutes. That's exactly how long it took for the biggest market on the planet to lose almost $1 trillion and win nearly all of it back. As if nothing had happened. May 6, 2010. Nowhere broke out that day. Not a single bank collapsed. Not one piece of news came out that could explain it. And there was no panicking crowd of sellers either, because by then, there were almost no people left on this market. Machines were selling, and machines were buying. From each other. Regulators would later spend 5 months reconstructing that half hour, millisecond by millisecond. And 5 years later, the trail of this story would lead federal agents not to Wall Street, but to a house with lace curtains in West London, to a bedroom where one man traded against the whole world without getting out of bed. To understand how an echo in an empty hall almost became the voice of a catastrophe, we have to take that Thursday apart, minute by minute. Let's descend. To be honest, the day was not a calm one. Tires were burning in Athens. Europe was shaking over Greek debt, and the American market had been sliding since morning. By lunchtime, down 2 to 3%. Nervous, but normal. Days like this happen every year. At 2:32 p.m. New York time, something clicked inside the market. Invisibly, not a single news wire flinched. 9 minutes later, the slide turned into a skid. For minutes after that, a cliff. At 2:45, the Dow Jones was falling almost 1,000 points. The deepest intraday drop in its history at the time. Almost minus 9%. Almost $1 trillion of market value erased. Shares of global giants were printing at absurd prices. We'll come back to that. You won't believe the numbers. And then, just as inexplicably, the market turned around. By 3:08, most of the losses had been bought back, as if someone had rewound the tape. The first theories appeared that same evening. The fat finger. A trader supposedly mistyped and sold billions instead of millions. Elegant. And wrong. A cyber attack. Scary. Also wrong. The truth turned out to be stranger than any theory. But to see it, you first have to understand who is actually staying in this hall. How do you picture Wall Street? The movies paint a crowd. People in colored vests, shouting, waving papers, phones pressed to both ears. Well, by 2010, that hall no longer existed. The real market is a data center in New Jersey. Rows of servers, cold air, the hum of cooling fans, and not a single human being. A silence in which thousands of trades happen every second. Here is how it works, on your fingers. Every exchange is, at its core, one table. It is called the order book. 2 columns. On the left, everyone who wants to buy, and their prices. On the right, everyone who wants to sell, and theirs. A trade happens where the columns meet. There used to be a man standing between those columns. A market maker. His business, always stand on both sides. Buy a little cheaper, sell a little higher, and pocket the tiny difference. By 2010, that man is a program. And next to it, a whole new species, high-frequency traders. Robots with a single strategy, speed. They hold a position for seconds, earn fractions of a cent per trade, make millions of trades, and by evening they try to land on zero, keeping nothing overnight. Their edge is measured in microseconds. Light in the fiber between Chicago and New York. Even that is too slow for them. And here is the key word of this story. Liquidity. In plain terms, how many real buyers are standing in line right under the current price? On a calm day, it feels like an ocean. Sell as much as you want, someone will buy. But it is not water. It is mirrors. Most of that line is those same robots, ready to vanish faster than you can blink. The hall looks full. The hall is empty. On May 6th, a real seller walked into this hall. Big, alive, and with a very simple plan. The seller was not a predator and not a speculator. An ordinary large mutual fund from Kansas, managing retirement savings. The official report hides its name. The press worked it out fast, Waddell and Reed. On that nervous day, the fund decided to hedge its portfolio against a fall. A perfectly legal, boring, responsible operation. The hedging instrument, the E-mini future on the S&P 500. In plain terms, a contract that bets on the entire American market at once, traded in Chicago. Sell such contracts, and if the market falls, the hedge gains and covers your loss. The volume they decided to sell, 75,000 contracts. About $4.1 billion. A lot, but not unprecedented. Volumes like this get sold. The question is always the same. How you sell. Last time, selling a comparable volume. This same fund stretched the operation over hours, with humans at the wheel, watching the price. This time, the sale was handed to an execution algorithm. With one single rule, sell at 9% of the trading volume of the previous minute. That's all. No limit on price. No limit on time. The machine was told, watch only the volume. So it watched only the volume. Remember this rule. It looks harmless. A fraction of volume means you sell gently, along with the market. But it has a dark side. If trading volume suddenly rises, the algorithm starts selling faster. Hold that thought. In 2 minutes, it explodes. If everything so far makes sense, that is by design. Thesis exists for exactly this, taking the machine behind the money apart, screw by screw, until it stops being magic. Subscribe, because from here, this machine starts eating itself. So, 2:32 p.m., the algorithm starts selling. Who buys first? The fastest, of course. Robots. And robots have no plan B. High-frequency traders buy the first wave. They are always first. But remember, an HFT is not an investor. Its rule is to never hold risk longer than a few seconds. Warehouses stuffed with contracts that keep getting cheaper, the robots do the only thing they know. They start selling too. To whom? To each other. In the official report, regulators will name it after a children's game, hot potato. Here is the number that chills. In 14 seconds, the robots pass through each other 27,000 contracts. Almost half of all trading volume. And in those 14 seconds, not a single new buyer showed up. The same hot potato, flying in circles in an empty hall. Now remember the funds rule. Did trading volume spike? It spiked. The robots are playing hot potato. So the algorithm sees rising volume and sells even faster. Sales feed the volume. Volume feeds the sales. The loop is closed. A sale designed for hours unloads in 20 minutes. Into a falling market. Then the fire jumps from Chicago to New York. Between the future and the stocks themselves stand arbitrage robots. If the index bet gets cheaper than the basket of stocks, they sell the stocks and buy the future, leveling the prices. Usually that's useful. Right now, it's the pipe that pours the crash into the entire stock market. And here is where liquidity disappears. Those same mirrors. Market-making programs see a chaos they don't understand and do what they are programmed to do with the unknown. They leave. Some switch off entirely. Others leave formal placeholders. Quotes posted just to be present. Buy at 1 cent. Sell at $99,999. These orders are never meant to execute. On May 6th, they did. Accenture, a consulting giant with tens of thousands of employees, trades at 1 cent a share. Sotheby's, the auction house, at $99,999. Procter & Gamble loses a third of its price in minutes. The Dow, minus 998 points. Almost minus 9%. $1 trillion into thin air. Notice what is missing here. Human panic. A human would not even have had time to get scared. It all fit into minutes. This red curve is not an emotion. It is machines, perfectly executing their rules. Each one its own. What stopped it was not wisdom. Not heroism. Not a regulator. 5 seconds of silence. In Chicago, at the CME exchange, deep in the code, sits a fuse, stop logic. The idea is simple. If the next trade would move the price too far in one jump, trading freezes for a moment. At 2:45 and 28 seconds, it tripped. The pause, 5 seconds. Just 5. For a human, nothing. For machines, an eternity. The loop of sales, volume, sales is broken. Algorithms living on a millisecond rhythm are forced to stop and look around. In 5 seconds, real buyers make it back into the book. Live money that saw absurd prices. Trading reopens. And the market bounces back almost as vertically as it fell. By 3:08, most of the crash is bought back. The day will close down a little over 3%. A bad day. An ordinary bad day. Then, the cleanup. The exchanges cancel more than 20,000 trades in over 300 names. Everything that traded more than 60% away from normal price is ruled clearly erroneous. The line is drawn through living flesh. The 1 cent Accenture trade? Canceled. But someone's stop loss, a protective order that says sell automatically if it falls this far, fired at minus 59%. And it stands. Protection built against a catastrophe became the catastrophe. Minutes after the bounce, the regulators, the SEC and CFTC, needed 5 months to rebuild those minutes, millisecond by millisecond. In the fall, the report lands. No villains, just a giant sale executed by a blind algorithm, and a market whose depth turned out to be mirrors. Case essentially closed. Or so everyone thought. For 5 years. And then, in April 2015, agents knocked on the door of a house with lace curtains in West London. Before that door opens, here is the question that would later split traders and lawyers alike. Could one man in a childhood bedroom crash Wall Street? Type it in the comments, yes or no. And subscribe. The ending of this story is stranger than any theory. His name was Navinder Singh Sarao, 36 years old. He lived with his parents in Hounslow, a modest neighborhood by Heathrow Airport. No bank, no fund, not a single employee, a computer in a bedroom, cheap internet, and the same e-mini futures market where it all began. He never tried to get hired on Wall Street. He played against it. What he was accused of, on your fingers. The trick is called spoofing, from the word deceive. You place a giant wall of sell orders into the book, tens, hundreds of millions of dollars, that you never intend to execute. The robots see the wall and conclude, sellers are many, the price is going down. And they start selling themselves. The price dips. You quietly buy cheaper and cancel the wall that never really existed. Sarao, the prosecution says, perfected this. His modified program automatically moved the wall away from the price, so it could never be hit. The scale. In some minutes of May 6th, his fake orders were a noticeable share of all the selling pressure in that book. In that single day, he made about $879,000. Over the years, around $40 million. From a bedroom. The headlines will write, The Hound of Hounslow. And louder, The Man Who Crashed Wall Street. And now, the honest caveat, without which this story would be a lie. The official 2010 report never mentioned Sarao at all. His orders were a drop in that day's ocean. And the detail his defenders love. He switched his program off minutes before the crash itself. Most market researchers agree on the uncomfortable. Sarao is not the cause. Sarao is a symptom. The cause is the design itself, where a wall made of nothing can move trillions. The ending is human. Extradition to the U.S. A guilty plea to spoofing and fraud, not to crashing the market. For 4 years he cooperated, explaining the mechanics better than any expert. The sentence, January 2020, 1 year of home confinement. In his parents' house, the judge weighed two things, an autism spectrum diagnosis made after the arrest, and the fact that by then he had lost almost all of his millions. The man who beat the robots was cleaned out by ordinary earthly scammers with safe investments. The only human ever named responsible for a $1 trillion crash never spent a day in an American prison for it. And possibly he never caused it. Then one last question. If no human is to blame, what exactly got fixed? Some things were fixed honestly. A month after the crash, every single stock got its own fuse, a move of more than 10% in 5 minutes, and trading in that name freezes. Later the system got smarter, limit up, limit down. The price simply has nowhere to execute outside its corridor. Placeholder quotes, that famous 1 cent and those 99,000 were banned. 5 seconds of silence are now written into the rules, not into luck. Did it cure the market? No. October 2014. U.S. Treasuries, the calmest market on earth, make a move in minutes that statistics promise once in centuries. August 2015. Hundreds of ETFs crash double digits at the open and bounce right back. October 2016. The British pound drops several percent in seconds at night when nobody is trading. The flashes got shorter and smaller, but the physics is the same. And here is the big takeaway. On May 6th, 2010, nothing broke. Not one machine failed. Each executed its rule perfectly. The fund hedged honestly. The algorithm honestly sold 9% of volume. The robots honestly shed their risk. The market makers honestly walked away from what they didn't understand. A crash is not the machine breaking. It is the machine's mirror, a market that bought speed and sold understanding. That empty hall never went away. It only got faster. And if you have a pension, a fund, any bet on the market, you are already standing in it. The only difference. Now you know what the echo sounds like. And that 5 seconds of silence can cost $1 trillion. And if you want to see a market where the machines hunt not each other, but you personally, I have a video about the bots that quietly skim money off every trade you make. It's waiting right here. If this video helped you see the machine behind the money, subscribe. Honestly, it's the best thing you can do for the channel. And the next video is already here.